Welcome back, D-traders. The short trading week is coming to an end. Common Americans are certainly focused on the pre-Christmas sales. What are investors focused on? Let's discuss in our video review. On Thursday, American traders were away from markets, but futures on the benchmark stock indexes traded cautiously higher. Wall Street was still digesting the news released on the previous day. The key stock indexes traded mixed in the pre-market. The Dow Jones retained optimism, having climbed 0.2% in the pre-market. The Nasdaq dipped 0.17% due to gloomy news from China. The trading volume well below on Wall Street. Investors are anticipating retail sales data. The background is fragile today. To reinforce optimism, the S&P 500 is expected to trade in the corridor between 3,970 and 4,060 points today. Wall Street investors are eager to digest and grasp the point about economic prospects in the United States. Early investors cheered the dovish reversal in the Fed's rhetoric after they had absorbed the minutes of the November meeting. And today, analysts have spotted other factors which were neglected during robust buying. The ghost of a recession emerged in the Fed's minutes. Of course, traders are aware of such prospects. Fed economists warned again that the United States is facing the risk of a slipping into recession next year. Fed policymakers pointed out growing pressure on consumer spending, global headwinds, and the high borrowing costs as short-term obstacles. The question is still open whether the U.S. economy will extend its growth or dip into recession in 2023. The combat against high inflation and fast rate hikes act as a double whammy for American consumers who have to deal with the soaring inflation and high interest rates on their credit cards and debts. At the same time, recession prospects give the hope for a successful December in Wall Street. The S&P commonly grows by 1.6% in December, the strongest average growth than in other months. December is usually a strong month because hedge funds, managers buy shares which lock the best performance within the year. September is the worst month with an average decline of 0.7%. So Wall Street is anticipating a Santa Claus rally, which has brought the strongest growth to the stock market in the last 5 days in December and the first 2 days in January, in 75% of cases since 1945. This year, investors rely on the gifts from the Fed Reserve. They are looking forward to opposing a slowdown in the pace of monetary tightening. Amid such hopes, the S&P 500 has been able to gain almost 10% in November. As for the economic calendar, the market awaits fresh data on consumer activity in the United States. The information background is rough today. Amazon employees around the world, including the United States, Germany and France, are going to declare a strike on Black Friday. So iPhone production rates could slump at least by 30% because of unrest among employees at the Apple's production facility Foxconn due to the COVID resurgence. And in this context, high-tech stocks are trading cautiously as the oil sector is under pressure. Anyway, the thin market today does not provide a real picture. Market sentiment will clear up on a Monday. The US dollar index is trying to gather steam after it had been stuck in a range around 106 for a few days. Having grown 0.4%, the index now stands at 106.30. The intraday corridor for the index is seen between 105.70 and 106.80. The US dollar index hovered around a 3-month low on Friday. It's on track to close with the weekly losses because speculators are worried about the prospects of the dovish notes in the Fed stance as early as in December. The minutes revealed that most policymakers think it would be appropriate to moderate the pace of further rate hikes in the near future. Such remarks pushed the US dollar down. On the contrary, aggressive monetary tightening is the driving force which has propelled the US dollar 10% up this year. No market participants are already pricing in a slower pace of rate hikes, having assessed the current picture in the US economy. Nevertheless, it's not enough for a new rally of the US dollar. A bounce of the US dollar subdued the Canadian dollar's strength. The USD card pair is trading higher, so it has edged up 0.23%. The instrument is expected to trade in the intraday corridor between 1.3290 and 1.3390. The Canadian dollar stayed at about 1.3380 against its American rival, not far away from its 8-month peak at 1.3250 printed earlier this month. The loonie is winning favor with investors because of the hawkish Bank of Canada. Governor Tiff McClellan said in his speech at the House of Commons that inflation remains at elevated levels and warned that the central bank had not completed its cycle of rate hikes yet. The news does not inspire consumers but encourages the loonie. So, still, the commodity-reliant loonie cannot boost its strength due to the overall bearish trend in the oil market. Despite a moderate 1% recovery in the oil prices today, the benchmark rates are closing on Friday with weekly losses for 3 weeks in a row. The oil market remains quite ahead of the agreement of the Russian oil price cap, which will come into force from December 5. Besides, the EU is going to ban Russian crude exports in full. OPEC and its allies are due to hold a summit on December 4. These factors damped the loonie strength even despite the hawkish Bank of Canada. The crypto market is taking a back seat. Digital assets are trading sideways. Bitcoin has slipped 0.3% today, trading with a range between $16,200 and $16,700. Altcoins are following suit. Ethereum, Solana, Ripple, and Litecoin are wavering between minor dips and gains. Despite sluggish steady trading of popular tokens, the stability is shaky. Market quotes could tumble after any bad news for the crypto community. And Bitcoin is likely to trade in the range between $15,500 and $17,200 today. InstaForex team wishes you gainful trades before the weekend. See you next week.